An ETF that uses leverage, caps your upside, and holds other ETFs inside of itself. On paper, HYLD, it sounds kind of like a Frankenstein ETF product, but here's the thing. It's working, not just kind of working, it's crushing expectations big time. Fasten your seatbelts, folks. This is going to be a good one. If you have been looking at Canadian income ETFs, there's probably a very little chance that you have missed Hamilton's HYLD. It is one of the most aggressive income ETFs on the market today. And, well, it has quickly become a favorite among income-focused investors. In fact, it is also becoming very popular with dividend growth investors who may be looking just to add an ETF or two to add some oomph to their monthly dividend totals. This one certainly measures up to those expectations for sure. So what is it that makes HYLD so different? What makes it so successful? At its core, HYLD is a fund of funds. It doesn't hold stocks directly. Instead, it holds a carefully selected mix of Hamilton's own yield maximizer ETFs. Each of these underlying ETFs focuses on a specific sector, like, well, tech, financials, healthcare, also energy. And in addition to that, they also use a covered call strategy to generate premium income. HYLD then scoops them all up and adds a wee bit of leverage, around 25%, to boost the overall yield. The result? A diversified, income-focused powerhouse designed to generate serious monthly cash flow while still maintaining exposure to U.S. equities. I will just add there is a tiny, tiny, tiny sliver of Canadian exposure in this one as well. We will take a deeper look into those ETFs in just a moment. A sub to the channel is the best way to get a deeper look into some future content. Before we get into the numbers, I did want to briefly address some speculation that HYLD may be on the verge of, yet another dividend increase. I was watching Adriano over on the Passive Income Investing, and he was recently pointing out that a few of the underlying ETFs have raised their dividends, which in turn has increased some of that income that HYLD is receiving. That is very interesting for sure. Could this increased income translate into a dividend increase? It sure would be nice, and I do hope it does. But at the time of recording, it's still 100% speculation. But I sure hope it comes to pass. Of course, we are not here for speculation, but rather the current fundamentals. So if there are numbers involved, we need to call on the captain of covered calls, the lieutenant of leverage, the one and only Mr. Math. As usual, we're going to start with a little bit of that surface data. So at the time of recording, their current value is coming in at $13.86, and they've got an NAV of $13.80. Now, they do have a pretty healthy portfolio. In fact, their net assets under management coming in at $906.14 million. And there's a lot of volume on this one. According to Yahoo, their average volume is at 147,907. Now, management fee-wise, it comes in at zero. However, they do charge the fees of the underlying ETF. So when all is said and done, you have a management expense ratio of 2.37%. Okay, these numbers look great, but let's dive a little deeper. And I really want to see, well, who they're holding. So when it comes to their holdings, as I mentioned before, this is a fund of funds. So let's see which ETFs they are holding. Making up 66.35% of this fund, we have the Hamilton U.S. Equity Yield Maximizer. Their ticker is SMAX. Up next, we got a lot of technology coming in, 28.91%, and we've got the Hamilton Technology Yield Optimizer. Well, that's a good name too. A Maximizer, QMAX, QMAX. All right, at third spot, taking up 9.80%, we've got the Hamilton U.S. Financials Yield Maximizer with a ticker of, you're going to see a pattern here, FMAX, so FMAX. Up next, we get the Hamilton Healthcare Yield Maximizer. This is taking up 7.75% of that basket. Ticker of, you guessed it, LMAX. All right, we now have this is our exposure to gold. I love gold. We got the Hamilton Gold Producer Yield Maximizer AMAX taking up 4.90% of that basket. We also have the Hamilton Energy Yield Maximizer EMAX taking up 3.55%. Now, you might be thinking, why so low on energy? Well, some of the, particularly the SMAX, definitely has a good exposure to energy in that as well. All right, next we got the Hamilton REITs Yield Maxer at 2.51%. And this is one of my favorites, RMAX. This one does hold 50% Canadian REITs. So this is part of that Canadian exposure I was talking about. Now, there's also a little bit of fixed income in the form of the Hamilton US T-bill Yield Maximizer, 1.39%. So that's HBIL.U. That .U means it's pegged to the US dollar. We also have the Hamilton US Bonds Yield Maximizer, HBND.U, also 1.33%, and also pegged to the US dollar as well. I really do like this mix, as it does bring a lot of diversification to the fund, without a doubt, very well diversified. Now, okay, I do want to peel back that final layer, and I want to take a look at those, take a look at their dividends and returns. When it comes to the dividend, this is the part, this is what we're here for, right? They have a yield of 12.83%, monthly dividend of 14.5 cents per share. Now, they do have, that dividend has risen over the last 5 years. 1.01% would be the 5-year average dividend increase. Now, you do have to take that with a grain of salt, as for one, they've not been around for a full 5 years yet, as their first dividend dropped back in 2022. You also have to take into consideration that they began trading at the beginning of a bear market, and then that evolved into an aggressive rate hiking environment. And between the two of them, they certainly took their toll. At one point, this dividend did fall all the way down to 12 cents per share. But, and this is the best part, it did recover nicely, which has created, at least to me, I feel a lot more confident about this fund for sure. All right, let's take a look at those returns. On their 3-year, the return on investment coming in at 1.32%. Factor in the dividends, total return 36.94%. This is an income fund. We're not really expecting a lot on the return on investment. It's that total return that we're looking at. Now, with that being said, on their 1-year, we got a little bit of an interesting situation here. The return on investment's coming in at 7.44%. So that value is just the price of their shares. It has risen 7.44%. That's fantastic. Add in those dividends, total return 20.82%. So yeah, really, really good on that 1 year. Looking at the 3-year annualized, that is coming in at 11.05%. These are some very solid numbers. And in the last year, having some decent growth in addition to the dividends has really helped boost, the total return. I do want to take a very quick look at the tax profile of their dividend for 2024. Obviously, that's the last tax profile we have access to, but in 2024, they saw return of capital 69.9%, capital gains at 11.4%, other income 8.3%, foreign income 4.3%, and because of that little tiny bit of Canadian in there, we did have some eligible dividends of 0.1%. What that all means is that, based on that, the best place to hold HYLD is in a registered account like your TFSA or even your RRSP. If you are holding HYLD in a non-registered account, just be prepared for a slightly more complicated tax scenario. I do love this ETF quite a bit, and I suspect it may very well continue to exceed expectations this year. It will be, it's going to be very interesting to see how it fares in the next bear market. And if that last one was any indication, I'm really suspecting they will be just fine. If you are interested in HYLD, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on dangerous ETFs. Thank you for watching, and I will see you in the next video.